Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBS MoneyWatch, and I'm joined by Jack Otter, the executive editor, and we have a very special in-studio guest star today. Henry Blodget is CEO and editor-in-chief of Business Insider, which he launched in 2007. He's a former Wall Street analyst. He also is the author of The Wall Street Self-Defense Manual, a consumer's guide to investing. From 1994 to 2001, Henry worked at a bunch of different firms, so he knows a little bit from the inside and now the outside. And Henry, thanks so much for joining us.
Thank you for having me.
So let's get it right going here. This site is chock full of amazing stuff, first of all. Especially like the interspersed sports stuff. Is someone a huge hockey fan at Business Insider?
We have lots of sports fans among our readers.
I feel like there's like more hockey coverage. I'm a hockey fan, and this happens to have an exorbitant amount of hockey coverage, which is nowhere else to be found, not even in the New York Times.
We have a great team, and they are passionate about lots of sports.
Excellent.
So you're seeing it.
Fantastic. So we just had the caucus. I know you've probably heard about that.
I did watch
a little
it.
Something about that. As you look ahead into 2012, big political year, fourth year of the presidential cycle, which Jack's very excited to talk about, so we're going to let him do that. But what do you think about how this landscape is shaping up and how it might impact financial markets or the economy as a whole?
I don't think the political situation is going to have that much of an impact on the economy because I think that the country is very much gridlocked between the parties. Nothing is happening in Washington. It's very unlikely that the election is going to change that. I think it's a foregone conclusion that Romney is the nominee. The media can try to create all this controversy and everything else. I think it's a foregone conclusion, as much as the Republicans don't want it. And Romney's pretty centrist. So even if Obama should happen to lose the election, it's not like you're going to have radical changes. So I think that politics is basically frozen. That leaves us with the economy. Lots of headwinds in the economy probably for the next decade.
Now, Bo Jack, who loves to talk about the presidential cycles, it is the fourth year of a presidential cycle. What usually happens, Jack?
Well, the reason that I like the presidential cycle is because the only market prognosticator in whom I ever have any faith is Jeremy Grantham, and it's one of his favorites. He's big on the third year, which tends to be the best. The fourth year is the second best. Now, second best out of four really ain't that great, but the idea is that the nominee, the Fed, everyone who's vested in a decision in November of 2012 will flood the market with stimulus that tends to boost the stock market. And so going back to at least Roosevelt, you see that year three and year four effect. The problem is we've had so much stimulus in recent years that I think it's kind of negated it this year. As you saw, we didn't have much stimulus. We had lots of stimulus last year, but the market ended flat. This year, I actually am somewhat optimistic, largely based on the pessimism of everyone else. And I think to me, the wall of worry is what excites me more than the stimulus, which there'll be some of it, but as Henry pointed out, there's gridlock, and that's going to stop some stimulus from happening.
But Henry, you did talk about headwinds, and so, of course, the obvious big, elephant in the room is Europe. And as you look across the Atlantic, how do you imagine this playing out? Give me the best, the worst, and middle scenario.
Well, I think the big headwind actually is debt. If you go out, you look 30 years, we have been building up this massive debt load, and it turns out that a lot of our economic growth over that period is a result of being given a huge credit card. And now that credit card, the bills have come due, and people are realizing that. Lots of talk about how we can get consumers out from under the debt, but that is going to be a problem for a long time. It's the same problem in Europe. We've all built up our economies based on debt, and you can't just wave a magic wand and make it go away. I mean, people talk about that. It's a jubilee. We'll just let everyone walk away from everything. It's not going to happen because you've got a lot of people who own the debts. They obviously want to be paid back. It's going to be a long process. Very hard to see any solution in Europe that isn't just more of this kicking the can down the road, stuffing your hands over your ears, pretending the problem doesn't exist. And our politicians worldwide have showed us that they can do that for a long time. That's what we've done here. So maybe that continues. But again, I don't see any way out of the fundamental problem in Europe, which is you have economies that have different competitiveness that are now under the same currency, which is like a straitjacket.
Would you expect that any of the countries would leave the euro or would actually leave the Eurozone? Could we have a two-tiered euro where those, Angela is like whipping it up in the north, and then all of you bad guys in the south, you're on your own, screw. What do you think?
That certainly seems possible. as one outcome. I think in the near term, it will be more bailouts, effectively, until some countries just can't stand it anymore. Either that, or Germany is somehow persuaded at some point that they're going to have to cover the Southern Europe.
And the reality is, Jack, that's kind of funny, is that the ECB, the European Central Bank, are their version of our Fed, which has basically said, we will not do this, we're not going to write checks, we're not going to print money, but they are. That's exactly what they're doing. They're setting up facilities where, hey, you know, banks, all of you banks that made the bad loans to begin with, why don't you take our money at 1% for 3 years and do what you want with it? If you wanted to go help out some of those sovereign nations who are rolling over their trillion euros of debt in 2012, that would be fine with us.
Well, what you're seeing is they're muddling through. Yeah, there's all this silliness, but the fact is that they're putting Band-Aids on it. I mean, it's just like our AMT and just like our debt problems. We don't really solve it. We just kick the can down the road. That's what they're doing here. The optimistic view would be they can kick the can down the road enough that we finally get some growth and we can grow our way out of some of these problems. But I think Henry's talking about the long term there. The unanswered question is whether the euro is actually a good idea, whether it can work in the long term, whether a common currency across economies that are so different is actually possible. And I'm not sure it is. My suspicion is, just knowing human nature, that we're not going to face that reckoning for a while. So I think we'll just continue to kick that can down the road until either there's a crisis or we slowly grow our way out of this. I love Henry pointing out that this debt problem is, first of all, global, and second of all, 30 years coming. Because I think that's what people don't understand. You know, if you're a Republican, you think the debt problem started in the first month of 2009 when President Obama took office. If you're a Democrat, you say it started in 2002 or 3 when Bush cut taxes. But the truth is, it goes back to at least Reagan from a presidential perspective, but more importantly, I mean, cultural changes where people started using credit cards and houses got more expensive than we could actually afford, as we found out in a painful way. But a problem that has been building for 30 years is not going to get solved in November of 2012, for instance.
And Henry, you talk about, you know, headwinds, but part of that debt that's sort of sitting on top of the economy is putting pressure on economic growth. And so here in 2012, and you look at the various predictions, and you guys talk about this on Business Insider all the time, that, you know, we're looking at 2.5% growth. That doesn't seem strong enough to do anything.
It doesn't. It seems very mediocre. And one thing you are probably assured of is that that's wrong. Either the economy is going to grow much faster than that, or it's going to be much worse. We're going to have another recession. And one of the analyses that I love that you see again and again from folks who really have perspective is that economists are almost always wrong. They're almost always clustered around that 3 to 4% nominal growth. Now they're a little more conservative because it turns out that the headwinds idea is the consensus. And remarkably, they're almost always wrong, and it's almost always a significant amount of wrongness. So I'm confident that it's not going to be 2.5%. I don't know which way it's going to be wrong. Maybe we'll have growth, and that'll be a great year, but I think it's equally possible we'll have a bad recession.
You can join our chat room at MoneyWatch.com, and ZMW wants to know, well, you know, given that outlook, is it time to stash cash, or should I invest? If the latter, where would I go?
So here's the thing, and we were talking earlier, and I worked on Wall Street for 10 years. Was very much involved in the active management game. My clients were professional investors who are paid to try to beat other professional investors and build their business that way. Companies like Fidelity and all the companies you've ever heard of. Then, having left Wall Street and studied the game from the outside, try to figure out what to do myself and what makes the most sense for individuals, I can just say categorically, it is crazy for individuals to try to beat Wall Street at its own game, which involves thinking about what the economy is going to do next year, whether they should be in cash, whether they should be in stocks. That is a loser's game. You are almost always guaranteed to lose if you play that. So I think the way any individual investor should approach managing their own money is to ignore the economy, ignore the prognostications about what's going to happen, half of which are going to be wrong every year, and simply allocate your money across a spectrum that makes sense for you on a risk-reward basis. So if the caller or the emailer is actually in need of funds in the next 5 years, then it should be in cash, period. 100%. It shouldn't even be a decision. If it is retirement 25 years away, 30 years away, you've got a lot of time for the stock market to crash and then come back. so forth. So that's the way you make the decision. It's not on what people are telling you about the economy this year.
Well, it's funny because we got a question before the program from Pearl who wants to know the best investments for 2012, any particular sectors you see doing well, and now you've just refuted that. Poor Pearl.
And listen, let's go back.
Pearl.
So here's the thing with Pearl, because if you ask me that question, what I'm going to do is duck it. I can give you my gut on what will happen, and then what poor Pearl is going to do is she's going to go, I got to go find somebody smarter than Henry Blodget, some big Wall Street figure who will know.
Jack's here.
So here's the thing. We could ask Jack. We could ask anybody else. Go back to the beginning of last year. What were people predicting? Outrageous inflation because of the debt problem. People are going to stop lending us money. Bonds are terrible. It's only 3% interest for 30 years. You'd be crazy to buy a bond. What was the best performing asset class last year?
The 30-year bond.
Bingo. 15%. Remarkable returns. What was everyone so stoked about at the beginning of last year? Can't miss investment. Got to own it under any circumstances. Gold. Fortunately, gold didn't do that badly. It was actually up. It's better than stocks. Stocks were flat. Gold was up 7-8%. That's not bad. It's not terrible. It was down 20% in the last half of the year. I think at one of these years, when enough people get convinced that gold is just where you got to be because of this terrible debasement of currency, that's when you're going to have the mega crash and people are going to completely lose their shirts.
You know, gold
so all I would say is to Pearl is, don't go looking for that oracle that is going to tell you where to put your money next year. They do not exist.
You know what's extraordinary? Henry said, if half of them are right, half of them are wrong. It's actually even worse than that. You do much better by flipping a coin. As you know, you pointed out that 2% growth was consensus, therefore it's going to be 6 or -2. And that's the same thing with looking at what the prognosticators are expecting on Wall Street. And your bond example is certainly the poster boy for that. Now, we always recognize the emotional need to have that answer and to search for that answer. And so Henry talking about indexing and all that is gospel to us. But what we do say is that if you just can't resist the little Vegas inclination, take your important money, put that in a broadly diversified set of index funds, and then, okay, go ahead with 5%, play your hunch, and keep track of it. And I suspect that at the end of the year, it's going to be more like 4% or 3% of your portfolio because it won't do as well as your broadly diversified fund.
No.
But I want to hear Henry's hunch. He said he has a hunch. We're going to set it up by saying, we're not suggesting people do this.
First of all, let me also say that on the website, I see that Henry owns options or shares in Yahoo, eBay, Baidu, Amazon, Spark Networks, Microsoft, the Bank of America, Gartner Group, Time Warner, and some other companies. So, Mr.
Yes, Mr. Indexer.
That's his cost basis is so low he can't afford to pay the taxes on them.
Double. So tell me a little bit about those.
So I referred to my 10 years on Wall Street. That's when I bought all those. I haven't bought or I very, very rarely trade. I have not bought a stock in memory.
Really?
Yeah.
Okay.
Basically, I learned. I looked at the facts of how professionals have performed and individuals performed. I looked at the whole active management arithmetic, which is that half the people win and half the people lose, and then you deduct expenses and you're left with about a third of the people win. And by the way, the third that win this year, most of them are going to lose next year. So it's not a theory. The way this is often portrayed is, well, there's just two religions. You have your Buddhists and you have your Christians. And, people just believe what they want to believe. Nobody's right. In this case, somebody is right. And you know who's right? The indexers are right. The active managers are doing something else. They are paid to try to beat the market. When you are being paid to manage money, it is a whole different game. Individuals are not paid to manage money. They're hiring people to manage money. And the ones who are smart hire the index funds to manage their money. So these are legacy positions that I have.
Wait a minute. You got to be down on Bank of America. Why not take the tax loss?
I should. Very, very good. I have not cleaned it up. I've agreed with our readers on the site that I will tell them when I'm going to make a trade, and at some point I probably will blow out all those positions.
Okay, so
they're not huge. In
all right,
case,
so the gut for this year. We all have a little gut. By the way, Jack acted on one of his gut things, and he's living with that right now.
Yeah, exactly. And it's in a retirement account, so I can't even take the tax loss. It's just stupid.
But when it rises again, baby, you'll own it, and you will not have to pay any capital gains. So what is your gut telling you?
My gut is, and this is not a year forecast, but stocks are still expensive historically. And I know we're coming off this 10-year period where we've had terrible returns. Usually that heralds 10-year period of good returns. And in fact, it's one of the most reliable indicators. You look at how stocks have done over the past couple of decades. If they've done well, your outlook is for terrible performance. Of course, that's when everyone's most excited about them, so it's most dangerous. But if you look at stocks on a traditional valuation basis, where you take earnings and you spread them over the business cycle, so 10 years, so you're not looking at peak earnings right now, but you say, what are average earnings? Stocks are still about 20% expensive. That's not historically outrageous. It still is projecting a positive return over the next 10 years. So if your horizon is 10 years, stocks are probably better than bonds at this point. You are taking a huge risk if you buy treasury bonds, even if there's a little more upside there, because if we do get an inflation environment, you'll get crushed. Cash is a risk for the same reason. Stocks are an inflation pass-through if we ever get in that environment. So someone with a long-term outlook, no problem on the stock side. But my bias is that at some point here, we're going to have another pullback like we had in the 2008-2009 period, where you'll be able to buy more cheaply.
And do you think that it is worthwhile for people, even if you are in a diversified portfolio, to keep a little extra cash around just in case of that kind of event?
I think so. I think, though, as soon as you start with that game, which is I'm going to outsmart everybody and I'm going to try to time it and I'm going to wait for that dip, I'm going to get into it, you've got to recognize the psychology if the market does start to break down, which is what you're going to start to tell yourself is, I was so smart, and now I'm going to be really smart, and I'm going to hold out for that absolute low day when we get this, quote, puke point that they always talk about on financial TV, when everybody else panics, and I'm going to be there buying up everything for nothing.
Yeah.
And by the way, I can almost guarantee you're going to miss that day, whatever it is. And then the market's going to start to run up, and you're going to say, well, it's up today. I'm not going to be stupid and buy it. I'll wait until it crashes again. And then 3 weeks later, it'll be up 20%. You say, I would never buy it here, and you will have missed the bottom. So if you have the long-term horizon, today's valuations are fine. All you got to actually persuade yourself of, though, is if the market gets cut in half, which is eminently possible, you got to be ready for that and not get snookered into selling at the bottom because you think it's going to go down another 50% from there. Because if it drops 50% from here, it's going to look like it's going down another 50%. And that's why you see individuals from the time immemorial always bailing at the bottom. They freak out right at the worst time and bail because it's totally human nature, utterly panicked. And same thing happened in 2009.
And absolutely, and I would point out that was always one of my selling points when I used to manage money. I would say, I'm not here to beat the market on the way up. I'm here to prevent you from selling the bottom. That's it. That's like the biggest thing. If you can lose less on the way down, you're going to end up being really happy over the long term.
Can I ask Henry a question on the 10-year PD? I'd just love to drill down. What is the number there? Where are we now, and what is average?
So you're a fan of Jeremy Grantham, as am I.
Right.
The one place where I think Jeremy Grantham is going a little bit insane is actually the presidential cycle, which he has admitted as well. But on a valuation basis, he's putting the S&P 500 at fair value at about 1,000.
Okay.
950, 1,000. So
and is that based on a 10-year PD?
Yes. And what that means, by the way, what they're doing there is somebody who's just trying to say that stocks are a great buy now, which is a lot of people are. Interest rates are low and earnings are high, and of course stocks are a great buy based on that. Right now, profit margins, corporate profit margins, are at an all-time high as a percentage of revenue. Historically, every time that has happened in the past, they have regressed wildly to the mean and then well beyond the mean. And so what you have to believe, if you are arguing that stocks are really cheap today, is that corporate profit margins are going to keep going higher from the already record level that we have, and that unlike all previous history, they're going to stay there forever. If that happens, you're right. Stocks are really cheap. If history reasserts itself and profit margins regress back to the mean, and there are lots of reasons to think that they will, labor costs, international competition, all sorts of things that could go on, then stocks are much more expensive than they look. And that's what that analysis does, is it takes the whole business cycle, 10 years, and it says, let's average out the peak and the trough. Where are earnings relative to that? And that's when you come to about 950, 1,000 on the S&P 500. Now, the big problem with that analysis, because again, that's perfect analysis to make you think, I'm so much smarter than everybody else, is it is no help in predicting what the market's going to do over the next 3 years.
Sure.
None. So forget it.
And so here we are. We started the first couple of trading days. We're up a little bit today. Dow's up 20 points, and the S&P up 1/4 of a point. And so everyone starts talking about the January effect. Ooh, I love those. Those are fabulous. But I want to get back to the gut. Mr. Henry? Because you notice he dodged that question.
Yeah, he did. Flat out.
Let me just do my 60 Minutes face. So, Mr. Blodget.
Maybe he's going to jump in.
So
Iowa was a draw, you know?
So here's the question. Let's say you had a fun money account and you said, well, I could either go to Vegas and I get free drinks and that's great, but maybe I'll just play with some stocks or something. What's the something that you're a human being, I've heard, and there's something like floating around the back of your head, an idea. What's your idea that's maybe even tantalizing you a little bit?
From an allocation point of view, I'm underweight where I should be in stocks, simply because I believe what I just told Jack, which is that stocks are still historically expensive. Usually when we are correcting from a bubble of the magnitude of the one that we had in 2000 and 2007, we crash through fair value and we spend a decade below fair value until there is not a living soul on the planet who would ever even consider buying a stock.
Right.
That's
Stocks
the time
are
you want to
dead.
get them.
Business
and
week.
by the way, I have an anecdote that is actually encouraging to me that suggests we're sort of getting here, which is that yesterday on the site we had an article where somebody had computed how much cable TV costs you over a lifetime. And if you buy it at 23 and you have it to your 80, it was something like $125,000. You're flushing down the toilet by buying cable. By the way, if you invested that at a 10% rate, that's $4 million over your lifetime that you make. So I just tweeted that. I didn't think about it because 10% back in the 1990s, everyone's like, that's what stocks average.
That's half what I could make.
So suddenly the Twitter just exploded with all these people who are like, where do I find these 10% returns? Sign me up, dream boy. Obviously it's fantasy land. And what was so interesting about that is if you go back to the 1990s and you said, 10% returns, people are like, 10%? Screw that. NASDAQ's been up 25% for 5 years. No way am I going to rot at 10% returns. How unambitious is that? Get me an E-Trade account because I can do a hell of a lot better than that. Now, 10 years later, people are like, oh, out of this world, 10% returns, give me a break. That's a good sign.
We had precisely the same experience. We had a story about Starbucks raising its prices yesterday, pointed out what you would make if you invested the money over time. We used 9%, same thing. What are you, crazy? Where's 9%? And my response was the same as yours. We have a chart, actually, that shows how people are becoming less and less enamored of risk assets. Interestingly, they hate Wall Street so much they don't even want CDs. But I sent it to Sally. Oh, do I need to? There we go.
It?
Okay, so these numbers could get a lot higher, as Henry has been pointing out. But if you look even just last year, from February to October, more and more people said they're not willing to take any risk in the stock market. And
I will never feel comfortable investing in the stock market.
so I don't know where
like
that 29% has to go, maybe to 70%. But
what's amazing about that is if you go back in history, that doesn't just happen to individuals. It happens to fund managers, professionals, everything else. Warren Buffett has this great talk, or I guess it was an article in Fortune that he laid out the sort of history, the 100-year history of the stock market in the 20th century, where he goes back to the low points. And what you find is that for the 3 years leading up to that low point, pension funds are investing a tiny percentage of their assets in stocks because everybody knows that stocks are always a terrible investment, and why would you go there? So I think there's a long way we could go on that. But again, you get into this game of predicting it, you try to predict the bottom, and then you screwed yourself and you've missed it and so forth. So back to your question, not to dodge it. I am underweight stocks, but one of the best pieces of advice that I ever heard somebody give is actually James Altucher, who used to be a big investor himself, right, for TheStreet.com. He said, look, instead of trying to go in and play this game and play against Fidelity and SAC Capital and all these guys who have a $50 million research budget, who have the CEO they're on speed dial of 400 companies on their cell phone and everything else, they got 47 brokerage firms calling them with every tidbit of information. Instead of trying to compete with them, go invest in yourself. Create a business. And in 2007, that's what I did. Very scary. Step in, create Business Insider. Maybe it's going to flop. You could still flop. It's dangerous. It's exciting going to work every day because there's a big bet there. Hopefully we can make something out of it that people like. But that is what is exhilarating to me.
Interesting.
And it's one where I have a lot more control than I would ever have over buying a stock where another management team is doing it and where other investors have so much better information than I will ever have. There's no guarantee we're going to be successful, and it's the same with anybody in any business all the time, but it's the excitement of creating something and investing that, and I invested when we made it, so hopefully it works out.
Awesome. And Jack, do you have a little something up your sleeve that you're thinking about as you look ahead? We've got some questions about a few different assets, but is there something that's in your mind you're thinking about?
Well, not really, but I'll fall back on Grantham, who we keep on bringing up, and he's not the only one to say this, and that actually, it worries me a little bit that this seems to be the consensus, and you could actually go back to the entire decade when the quality trade was the consensus, and small cap stocks kept on going higher, and the big caps sat there. But I think in terms of reversion to the mean, your big dividend-paying quality stocks are both a little bit safer, so the roller coaster ride might not be quite so dramatic to force people to sell at the bottom. So it's good for that reason. And I think over the next 10 years, again, small caps have had a great 10 years, large caps have had a lousy 10 years. So over the next 10 years, I'd rather be in the asset class that did badly in recent history. So yeah, my hunch would be big cap stocks will do better.
I'm a total contrarian. I grew up as a commodities trader, so you'll have to excuse me for that. And by the way, gold did just have its 11th consecutive rising year. No, I agree with you about gold. I think it's crazy, actually. I have two areas that are very tantalizing to me, and one is brought up in the chat room. Someone asked about real estate. I am starting to feel really bullish about real estate. I really am. Not in a huge, broad-based way where you're going to double your money in 5 or 6 years, but if you can afford to buy a house with really cheap money, and you're going out and you're looking, and there are a lot of areas now where buying a home is cheaper than renting. There's a lot, not New York City and not a lot of the big cities, but there are places in the United States where it's a better deal. It really is. So I'm kind of bullish on real estate because everyone thinks it's, you know, horrible and never going to make money again.
And I think that's great. And I think if you actually look at residential real estate on a price basis, we've now gotten back to pretty much fair value.
Right,
we had this massive bubble,
right?
That's right. But now as price to income, price to rent, some of the other ratios that are the PE ratios of real estate, we're now back there. My concern there, and this comes off of Grantham's study of bubbles and everything else, is it's very rare to see price goes like this and then it stops at fair value and it's perfect and everyone makes money who waited. Usually what happens is it crashes through and nobody wants to touch it and it's very cheap for a long, long time. But the good news is, I think even not just for individuals, but if you are going to go into the landlord business, which again, you go back a few years, everyone thought it was so easy. This is just what you do. You buy a house and you rent, and they all got killed. But now rents are going up because people can't borrow the money from banks because banks are still strapped. They don't want to lend except to people who have all the money that they would ever need. So rents are going up as a result of that. And then the other thing about real estate that's nice is it's a real asset, and it will pass through inflation if the Fed is ever successful. Fed is secretly trying to create as much inflation as they can to get us out of this debt problem. If they are successful, holding cash and under the mattress, you're going to be killed. So there's huge risk in that too.
And another good thing with real estate is the supply constraint. I mean, we were just building half as many houses as we used to. That doesn't mean that prices are going up this year, but eventually, if supply keeps on falling, demand ain't going anywhere, eventually it'll be a good investment. And to Henry's point about the rent, you know, people still think real estate is a capital gains game, and it's not. It's an income game. And to the extent that your capital gains keep you just barely above inflation, if you're making income, great.
Yeah, and I would also say that people who go into rental real estate learned a terrible lesson, right? And in the bust, and that if you are prepared to do it, that's actually where there's some very interesting things that you could do. But there's so few people who are really prepared to do something like that. Let me ask for one MoneyWatch user asks about the direction of oil prices in 2012. Now, a funny thing happened in the oil market last year. If you recall, we spiked after the Arab Spring. Everything kind of collapsed around the summer and the whole debt ceiling debacle. And then lo and behold, here we are above $100 a barrel. What do you think, Jack? Are we looking at, I mean, I know that part of the reason oil's gone up is because of little geopolitical issues, but there always be geopolitical issues. That's the good news about the Middle East. They always can give us something. So
Absolutely.
What do you think about the oil market, or where we look long term around oil globally?
Sure. Well, long term, I literally cannot paint you a scenario, including the Mad Max scenario, where oil goes down in price. There is a graphic on CNN today that showed the concentration of the world's wealth. And good news, Americans, no matter what your income, you're in the top 1% globally. I mean, it's extraordinary. The global wage...
We're all 1%ers.
Yeah, exactly. The global wage is something like $30,000. So basically, you know, everyone above the poverty level in the U.S. is in the top 1% globally. So if, in fact, there's really any global growth, whether it's meat or wheat or oil, I think long-term prices have to go higher, particularly with oil, because I think smaller increases in demand can really push up prices hard. You can have a great growing season and wheat ends up rotting, in the field, whereas with oil that doesn't happen. So I think long-term, oil has to go up. Short term, the fund in the Middle East is going to push it higher. Again, I'm not saying people go trade commodities, but I would not go out and buy, an Escalade on the hopes that, once the Iran thing calms down, gas is going to be $1.50 a gallon.
I mean, short term, what could knock it down is you have a coordinated global recession again.
Yep.
And we had this before. It spiked to $145 a barrel, and then it was 40
a
year later because the entire global economy collapsed. But on the long term, it's very hard to come to any conclusion other than the one you just came to. And anybody who doesn't believe that and who believes all the wonderful arguments, people, oh, no, human ingenuity will find the oil in sand and everything else. Absolutely, no question about it. But look at what has changed in the world in the last 300 years. You had the population for hundreds of thousands of years bumping along at this tiny level, and now it has utterly exploded. And in the last 10 to 15 years, we've unleashed India and China, massive, massive countries that are now sucking down oil. If their oil consumption goes to even a fraction of what U.S. consumption does, there isn't going to be enough oil in the world. You take it out of sand, wherever you pull it out, it's not there. So you've got a finite resource and exponentially growing demand. I don't see how you come to a conclusion other than the one you came to.
And one important point is, the drill baby drill people will say, well, Henry, it might go up globally, but, we can just pull it out of our own soil. But that's not how commodities work. Commodities are priced globally. So it doesn't make any difference how much we pull up. If global demand spikes, the price is going to go up. So it's great for Exxon, not good for the guy filling up his SUV at the pump.
And, of course, someone in the chat room wants to know about gold. Has the peak passed?
I haven't the faintest idea. All I would say to you is that I unfortunately have been on the wrong side of bubbles in the past. If people look back on the internet bubble, they're like, oh, people are just idiots then. It was so obvious. What was more interesting is that from 1995 to 2000, everyone was very aware of the possibility that it was a bubble. Lots of people were saying that all the time. There's possibly a bubble. And so was I. I was an analyst following stocks. Like, sure, it looks like a bubble, and you should take steps to protect yourself as a result of that. And yet, year after year after year, the best investors in the world were carried out on stretchers after getting fired because they had declared it a bubble too early and their performance had sucked, and they got fired as a result of it. So the lesson that I learned in that, having gone through it and then missing the top, is bubbles always last longer than you think they will. Gold has certainly done that for a lot of people. Is it going to last another year, another 5 years? I have no idea. Is it going to go to 5,000? Absolutely could. No, why not?
Yeah, I guess.
But there is no support for it once it begins to break down. Gold is worth what other people are willing to pay for it. That is it. There is no cash flow from it. It is purely a what is the guy I'm going to sell it to willing to pay.
It's the most speculative investment you could find. The only way I can justify it is it's sort of like you can think of it as insurance. Like, gosh, if the world falls apart and people really do want to pile into gold as like the panic trade, then you have a little piece of it. But as someone who was a former gold trader, I can only say that gold bugs, I made so much money off of them. It was so awesome because there was religious.
It is. It's a religion.
Fever to it. And then you think, it's just another asset class. So
it's important to realize for what long stretches we've gone where gold has gone nowhere. Ben Graham, Buffett's teacher, warned about this starting in the 50s. Alan Roth on our site writes about how he knew when he graduated from college that gold would only go up, and so he put his $3,000 in graduation money entirely in gold. And now, if he'd put it under the mattress, he'd be in about the same place. If he put it in the stock market, he'd have $100,000. But instead, he's got inflation adjusted. He's right where he started.
That's a little distressing. Before we wrap up, just a couple of questions, Henry. You come from the business, and now you cover the business, and tell me how you feel around where regulatory reform has really gone. Have we created a system that's better than it was, pre-2008? Is there something that encourages you, or do you think this is just the same old, same old? How do you see the world today?
I think the global banking system or the U.S. banking system, I think it's worse still, which is that we have a system where the banks can take as much risk as they want, and they're still too big to fail. We have not gotten out from that. And by the way, I don't think the answer is more regulation, get really into the books, figure out what the banks are doing. I think it's disclosure. Got to disclose derivatives so people can figure out whether you're going to blow up the world and so forth. That's good. I can't believe that hasn't happened. And I think we have to find a way to let the banks fail. So if management is as stupid and reckless as the management of the big banks was in the 2005-2007 era, that they bet the firm and they lose, that they have to be able to lose everything. And that's fine. People learn quickly when they see everything that they have worked for destroyed. But right now we still have that guarantee. It is, you have to think for a second to lend money to a bank because you know the government's going to bail them out. There is moral hazard out the wazoo there. I mean, there's just nothing is done. From an investment perspective, I think the biggest problem with the idea that regulation is going to fix the problems for individual investors and so forth is this idea that somehow a level playing field can be achieved. The kind of information that the big investor, the hedge fund Galleon, who just is going to jail for 15 years over, he had very good information. He knew Goldman's earnings before it came out. He knew tech companies' earnings before they came out. So do lots and lots and lots of other investors, except you.
Yeah.
You will never know. Maybe once in a while you'll get some lucky little piece of information you'll have that might give you a little bit of an edge. Most of the time it's a complete illusion, and every little bit of information you get off of the TV, from research, everything else has long been known by professionals. You are effectively competing with the Pittsburgh Steelers, New England Patriots, with your little touch football league. That's how imbalanced it is, and that's with perfect information. That's if the regulatory system is working perfectly. So to me, the biggest message that investors should take away is there is no way they can win. No way. And so to compete and to believe the idea that regulators are suddenly going to somehow protect you, you do a little homework on the side, and you're going to invest intelligently, it is a mass delusion. And the faster we move away from that, the better.
From a policy perspective, though, what's the best prescription? Setting aside investment, if you're the advisor to Obama, Romney, or Rick Santorum next year,
but not Michelle Bachmann.
What do you recommend? How do we achieve smaller banks that can fail without taking the global financial system down with them? I mean, one point you made about how incredibly stupid they were, you're absolutely right, but also, I'd love to have Dick Folds' bank account right now, and he destroyed a bank. And still he's doing a lot better than I am.
When I say they were stupid, they were smart individually, no question, and looking out for number one. They were great
So
shape.
what can we do so that, you name the bank could go under, SocGen, for instance, which just might. How could we create a system where that could happen and the rest of us won't be destroyed, even if we're not invested in those banks?
I think you have to make it easier for the government to step in at the last second. You do not want Lehman Brothers. That was actually a disruptive event. It was telegraphed, everything else, but it did screw the global financial system for a while as people said, wait a minute, maybe they're all not going to be bailed out.
Sure.
And of course, then they all were bailed out after that. But the problem was it was a surprise, so forth. You want the government to be able to step in at the last second, say, your bank is toast, we're going to write down all of those debts, your equity is worth zero, all of your bondholders that lent you 100 cents on the dollar, you're only going to get 50 cents for the senior guys, or go down the stack and maybe some of the junior guys get almost nothing. And we're going to recapitalize it. We're going to fire the idiots who flew it into a mountain, but we're going to keep all the operations running, fine, and then we're going to sell it off in pieces, however long it takes. That's what the FDIC does when it seizes small banks.
I mean, that's really what Sheila Bair's argument
was.
That's
right. And people say, oh, but Citigroup, it's so big. We can't do that. We took over Freddie Mac and Fannie Mae, and we are still subsidizing them today. But it hasn't ended the world. I mean, it's terrible. It's outrageous. Taxpayers are getting hosed and all that stuff. We're still subsidizing all this stuff. But we took them over. It's not that big a deal. You could do the same thing with Citigroup and Bank of America. Take them over, fire management, zero out the equity, knock the bondholders. The system convulses for a bit, but then you recapitalize them and refloat the operations. Suddenly they're healthy again, and you go on.
And before we wrap up, though, do you think that there should be like hard caps on the size of banks, and should we not allow investment banking and commercial banking? Should we basically repeal Glass-Steagall? Should we go back in time and say this is too complicated? We are never going to figure it out. Tough luck, guys. Sorry, Goldman Sachs, go start your own trading firm. Here's your investment bank, and here's where you have your clients, and that's the deal.
The separation of commercial banking and investment banking worked for 70 years.
Right.
So why we wouldn't go back to that, I have no idea, other than the bank lobby obviously saying we can make a lot more money if we can take a lot more risk with deposits. So sure, go back to that. But again, the big issue to me, when you start to artificially constrain the size, our banks are now competing on a global playing field. They are competing against massive Chinese banks and massive European banks. So we're going to say to them, you guys have to be puny because in the United States, we have just decided that there's an arbitrary $1 trillion asset value, but you're going to go compete against a bank with $5 trillion of assets because that's China. Why are we doing that? I mean, that doesn't make sense to me. This is a global playing field. GE is a global corporation. GE is going to do business with a bank that can handle it around the world. So to me, it's not constraining the size. It is just giving regulators the ability to go in, hurt everybody dumb enough to invest, fire the management team, hit the bondholders, and then refloat the bank immediately.
This has been very excellent. Now, I just want to point out that we have a great thing to create some, like, excellent gag reel for you because you're like, you're never going to be able to compete. You're never going to be able to. And we're going to play that over and over again until people believe it. And you keep carrying out this message because, look, you know, as somebody who's been there and now, as you say, on the other side, I think that there's a lot of, you've got some street cred, right?
Well, here's the other thing you got to do is because this idea of indexing, which I hear you guys espousing, which is great, people hear this all day. They don't believe it. They actually just think it's a difference in philosophy. It's like, here are the people who believe that you can beat the market. Here are the people who are kind of wimpy and conservative who just don't believe that you should do that. When you actually take somebody through it and you let them interview you about, yes, but, yes, but, yes, but, and you answer all those things, again, there is a right answer and a wrong answer. And the wrong answer is, with a little bit of homework, reading your filings, watching a little bit of financial TV, you too can do better. And you should manage your own. That is it's not just wrong, it's completely misleading and unfair.
And delusional.
It's delusional. It is, you can walk onto the Super Bowl field and compete against the Steelers, no problem. Keep dreaming. This is America. Dream. Ambition, right? It's just playing with people's hard-earned money and telling them to do stupid things with it. So you should devote a show just to that. Have an active manager challenge, oh yes, but my great pick of 2 years ago that I made, and I'm going to ignore all the ones that cost me all the money and everything else.
Of course, what they always say is, well, how do you explain Warren Buffett? I'm like, well, he started a long time ago.
And by the way, Warren Buffett is going to be the first to tell you that when he got as big as he did 20 years ago or something, the performance has not been that great. And by the way, Warren Buffett has huge advantages over the things that you can do as an investor. First of all, he runs his own business. People can't fire him.
Yes.
If Warren Buffett were a private manager, he'd been fired several times along that run because he has these runs where he missed technology.
Yeah.
He's obviously lost it.
Right.
We've got to remove him. But so Warren does that. And then the other thing Warren does is he buys companies and manages them. He has control. That is very different than buying shares in a company where you have absolutely no control and everybody you're competing against on the trading game knows vastly more than you ever will.
Yeah.
And he gets great deals.
He gets great deals.
He gets a 5% dividend, 10% dividend. Yeah.
A minute before they're going to go out of business, he gets a huge dividend.
That's what you were looking for.
Yeah,
you
exactly.
wanted that. I signed you up for that Warren Buffett deal.
You know, and one more thing to back up Henry's point here is we've run the numbers, and if you invested at the very peak of the market in October 2007, you know, really bad timing, the very top of the market, if you put 60% of your money in a total market index fund that owns stocks, 40% in the bond market, you're up today. You know, after all this horribleness, you actually made money through all that.
Assuming you had the cojones to stay in.
Of course.
Right? At the bottom, which is why, by the way, I think balanced portfolio is the best part of a balanced portfolio is it does not make you freak out at the bottom. It just does not do that. All right, we have to wrap it up. Megan is completely freaking out right now herself because she's saying, wrap it up. But we loved having you. Henry, please come back. It was
Thank
fantastic.
you for having me. It's great.
Henry Blodget, CEO and editor-in-chief of Business Insider. Go check him out. And Jack Otter, I don't know what to say except that we are no longer ever going to buy an individual stock this year, 2012. Is that right?
Yes, and we need to get Henry in that little intro where we do the Hollywood Squares thing.
Oh, I'd love to have him on.
Yeah,
maybe we'll make you a regular. Watch out.
Perfect.
We're going to bring you downtown a little bit more often. This is Ask the Experts. If you have a question you'd like to ask us, ask the experts at MoneyWatch.com. We will see you next week. Thank you very much for watching, and thanks to Megan and Sally, who always put on a fantastic show. We'll see you next week.